If you're over 50 and watching this, you're asking one specific question. Exactly how much Bitcoin do I need to make a real difference to my retirement? Not hopium, not someday. A number you can actually target. And here's what most advice gets wrong. They either say buy whatever you can afford, which is useless, or they throw out fantasy numbers like one whole Bitcoin that feel completely out of reach. Neither helps you decide, so let me give you what you actually need. 3 precise ranges, 0.1, 0.25, and zero point 0.5 Bitcoin, what each one realistically means for your retirement income and runway, and the exact allocation rules based on whether you're 50, 55, or 61 right now. Because you don't need a whole coin to change your outcome. But you do need a strategy that accounts for your specific age and risk window. By the end of this, you'll know exactly which range makes sense for you and why. Being a late starter in Bitcoin is not the disadvantage you think it is. Here's why. You're not chasing 100 times returns anymore. You don't need them. What you need is 5 times to 10 times over the next cycle to create meaningful optionality. That's entirely different math. You're not building wealth from zero. You're preserving and extending wealth you've already accumulated. That changes everything. It means you can be deliberate, ignore the noise, and hold through volatility without panic. You're adding a mathematically scarce asset to a portfolio that already has structure. This is the edge sophisticated investors have. You don't need to be early. You need to be smart about position sizing. But here's where most people over 50 make their first mistake. They either allocate too conservatively, treating Bitcoin like a lottery ticket, or they over-allocate out of fear they've missed too much. Both fail. So let me show you the ranges that actually work. 0.1 Bitcoin is roughly $6,800 today. This is the minimum stake that actually matters. If Bitcoin reaches $250,000 next cycle, which some models like historical stock-to-flow patterns have suggested as a potential high, though keep in mind these have shown deviations recently and markets can change rapidly, your 0.1 becomes $25,000. At $500,000, you're looking at $50,000. Not retirement money, but meaningful optionality. That's a year of supplemental income. That's a buffer against inflation eating your fixed income. Here's the psychological trap that kills late starters. They see 0.1 and think it's not enough, so they do nothing. They stay in cash losing around 2.4% to inflation every year while waiting for a perfect moment that never comes. The smart move is to recognize that 0.1 is your baseline. It gives you exposure to the only asset with true supply scarcity, 21 million coins, no more, ever, while keeping your downside defined. Allocation rule. If you're 50 to 55, allocate 2 to 3% of investable assets. If you're 56 to 60, stay at 1 to 2%. If you're 61 to 65, this might be your entire crypto position, and that's fine. You're adding asymmetry to a retirement plan, but 0.1 is just the floor. Let's go deeper. Now we move to 0.25 Bitcoin. Around $17,000, this is where you cross a threshold. You're no longer experimenting. You're making a real allocation decision. At $250,000 per Bitcoin, your position is worth $62,500. At $500,000, it's $125,000. At $1 million, which some supply and demand analyses pointed toward over 10 years based on data up to now, though remember this is speculative and depends on continued adoption, you're looking at $250,000. That's a real chunk of retirement capital. 2 to 3 years of living expenses, or the down payment on downsizing your home, or the buffer that lets you delay Social Security to 70. You're building optionality into decisions you're going to face anyway. And here's what nobody tells you about this range. This is where the never sell strategy starts to make sense. Once your Bitcoin is worth $100,000 or more, you don't liquidate it. You borrow against it. Platforms exist where you can take loans at low interest rates, often starting around 3%, but up to 12% or more depending on the platform, your collateral, and market conditions, using Bitcoin as collateral. You never trigger a taxable event. You never sell the underlying asset. You just access liquidity when needed. That's how smart holders think. not exit prices, but perpetual collateral. Allocation rules. If you're 50 to 55, allocate 4 to 6% of investable assets. If you're 56 to 60, cap it at 3 to 4%. If you're 61 to 65, you're looking at 2% max. Risk tolerance at 50 is not the same as 63. You have less time to recover from drawdowns, but if you can stomach volatility and have other income locked in, this range gives you serious leverage. Which brings us to the third tier. 0.5 Bitcoin is roughly $34,000 today. This is the position that separates hobbyists from strategists. At half a coin, you're building a parallel retirement asset outside the traditional financial system. At $250,000 per coin, you're at $125,000. At $500,000, you're at $250,000. At $1 million, you're holding $500,000 in a non-confiscatable, globally liquid, scarce asset. That's 5 to 10 years of retirement expenses, or the entire funding source for long-term care, or generational wealth without probate complications. At this level, you can think in tranches. Designate 0.2 Bitcoin as your never-sell collateral base, and use the other 0.3 as your liquidity tier. You have options, and options are what retirement security actually is. Now, the honest risk conversation. 0.5 Bitcoin is not small. It's $34,000. Allocation rules are strict. If you're 50 to 55 with strong pension and Social Security, you could go 5 to 8% of investable assets. If you're 56 to 60, cap it at 4 to 5%. If you're 61 to 65, no more than 2 to 3%, and only if you're comfortable with 50% drawdowns before recovery. Because it will happen. Bitcoin is volatile, but you're betting that the long-term trend, more adoption, institutional flows, fixed supply, plays out over the next 10 to 15 years. Though, keep in mind, past performance isn't a guarantee, and risks like market downturns exist. And if it does, this becomes one of the best decisions you ever made. Let's address what stops most men over 50 from taking Bitcoin seriously. The belief that it's too late. That belief is not caution, it's risk. Because here's what happens if you sit in cash and bonds for 10 years. Inflation at around 2.4% erodes your purchasing power by 20 to 30%. Your fixed income loses value. You think you're being conservative, but you're guaranteeing a loss. Bitcoin is mathematically scarce. 21 million coins. Demand increasing, supply fixed. That's code, not speculation. The risk is not Bitcoin going to zero. The risk is remaining 100% denominated in assets being deliberately devalued. You don't need to swing for the fences. You need to preserve purchasing power and create optionality. Bitcoin, sized correctly, does both. You need 0.1 to 0.5 depending on your situation. Now, which one is right for you? 4 questions. First, do you have guaranteed income in retirement? Pension, Social Security, rental income? If yes, allocate more aggressively. If no, stay at the lower end. Second, what percentage of investable assets can you allocate without losing sleep? 2 to 3% means 0.1 Bitcoin. 4 to 6% means 0.25. 5 to 8% and you're 50 to 55, consider 0.5. Third, can you hold through a 50% drawdown without panic selling? If no, cut your position in half. If yes, proceed. Fourth, do you have other high-risk positions? If yes, Bitcoin should be smaller. If no, it can be larger because it's your only asymmetric bet. And here's the rule that overrides everything. Never allocate more than you can afford to see go to zero. Size it accordingly. But don't let fear paralyze you into doing nothing, because doing nothing is letting inflation quietly erode your retirement security. That's the real risk nobody talks about. So here's where you are now. You know the exact ranges: 0.1, 0.25, 0.5 Bitcoin. You know what each means for your retirement. You know the allocation rules based on your age. You know the decision framework. No more guessing. No more wondering if you're too late. You're not. You're exactly on time if you act with strategy instead of emotion. That's the difference between gamblers and independent thinkers. Gamblers chase the next 100 times. Independent thinkers build positions in scarce assets and hold them with discipline. You now have the blueprint. The only question is whether you'll use it. If you found this valuable, subscribe for more strategic, no-nonsense analysis. No hype, no promises. Just math, logic, and frameworks you can actually use. I'll see you in the next one.